Alrighty, it is 5:30, and it looks like I'm alone tonight, which is fun. I think it's probably more convenient for most of you guys to just get this via YouTube, which is fine. Tonight we're going to talk about insurance, life insurance. Not the most exciting proposition in the world, but oh well, it's something that needs to be done. To summarize it in the 1 minute version of this lecture, uh, I'm a big fan of term life, and I'm not a big fan of any of these any of these whole life type policies. Um, I like insurance that's does exactly what it says, simple insurance, term life kind of stuff, as opposed to whole life type policies that are sort of a blend of insurance and investment. And I think they end up in the end not doing exactly what you need and not getting the performance you would like. So we'll go through some examples and we'll look at the differences between the two. These are the objectives. So defining life insurance, setting your needs, creating a plan. Annuities. Annuities are kind of cool. Life insurance, you're betting you're gonna die at some point, and that's kind of how you win, which is not winnable. But an annuity that pays you for staying alive. So if some statistician, actuary calculates you should die when you're 65, 71, whatever, and you live to 75, you're winning. Every day you live past that, it's like a new payday. So that's kind of cool. Um, Define insurance, its purpose, principle. Why does life insurance? So, just to try and keep things simple, what you're trying to do here, and if you're a single guy, why would you do this? Because uh, you life insurance is not for the person who's moving on. Life insurance is for the person who the survivors in this case. So, um, you keep all that in mind. What you don't want to do is you don't want to depart and leave somebody with a whole bunch of bills and problems, and they're probably going to miss you. Let's hope. And just to make it worse, if you leave them broke, well, they may not miss you as much. They may be a bit angry. But anyway, you would like to, you know, enjoy that the good feelings for as long as possible, and you can do that by providing for them and not leaving them in the lurch. So, you calculate your life insurance based upon your debts and what it's going to take to keep life going on a more or less normal basis for the survivors. So, kind of jumped into these purposes. Yeah, one big debt would be that home mortgage. If you pass on and the house is paid off, and something extra to take care of things, that is what you can do. Also, the medical expenses. Well, you may have incur sizable medical expenses before you leave, and that would be bad too to leave them again with a big bill. Sometimes you can actually get policies that have accelerated payoffs where you can actually use if you're diagnosed with a terminal illness. Um, Potentially some of that money can be used. So we got a few folks who joined. That's good. I started right at 5:30. My apologies. But anyway, also leave part of your estate, some actual money to you know get by, something to remember you for, and education for children, which is important. Principle of insurance, yeah, it's a grim task, but there's somebody out there figuring out, based upon everything about you, your age, your sex, um, and then all they're going to get all sorts of lifestyle things, smoking and stuff like that. But generally, women live a little bit longer than men, and men tend to have more bad habits. So it's a combination of factors. But anyway, women will tend to outlive males. Um, how long we live, yeah, that's what your premium is based upon. So yeah, like I said, it's a cold hard task. Somebody somewhere, an actuary, is calculating, and it's a big gamble here. They're betting you're going to live long, and you want to be prepared in case you don't. So again, that's why I like annuities, because annuities, you're on the other side of the equation, which is nice. Do you need life insurance? So again, the example, the single, let's say the CIA guy who's in that line of work because he's an orphan and he's got nobody. Well, he doesn't need any type of insurance. But if that's not the situation you find yourself in. Hopefully, um, you want to make sure that there's some you know some process to take care of the others in your life. So, how much money do you want to leave to your dependents should you die today? Well, the big thing is it shouldn't be like winning the lottery, but there should be something for education. Also, when do you want to retire? Income do you think you'll need? This gets into the whole life principle. And again, I don't like mixing, apples and oranges. I'm not a big fan of whole life. And in fact, I was checking out a few other sites too, and I think most people agree with me. There's Dave Ramsey, who's kind of boring to listen to, but he had nothing good to say about whole life as well. How much will you be able to pay for your insurance? Again, that would drive you towards the term life decision, at least at this point. And we'll talk more about the differences between the two as we go. Okay, so just trying to figure out how much you're going to need, some ballpark figure rather than just saying 500,000, whatever. Pardon me, half a million, whatever you're going to need. There are some sort of formulas, but again, they don't take variables into consideration. But you will need 70% of your salary for 7 years while your family adjusts. Well, you know, so if you're making 80 grand a year, um, you would need, you know, 70% of that and multiply that by 7, and that's what it's going to work out to. The DINK method, this is kind of deceiving because this, they're saying, oh, this is easy. Just get one half of your debts plus the funeral expenses. Well, the thing is that you and your, partner probably bought some, big Mondo house, and um, it probably took 2 salaries to pay that mortgage. So, again, it's not as simple as all that. Well, I guess that would cover part of the debts, but again, it's going to be a bit more complex than this. But these are a good starting point. Just if you're setting up your amounts to sort of double check these figures. Okay, the non-working spouse method. So this is kind of to get the kids, up to age 18. So multiply the number of years until the youngest child reaches 18 by 10,000. So again, I would not be comfortable. Let's say you've got a 2-year-old. You're going to leave 160,000 and call that good. I don't think that's a good idea. Anyway, family need method, a more thorough than the first three because it also considers employee provided insurance, Social Security benefits, and income and assets. So I agree with that method, all but the Social Security. Most people, I believe, are under illusion that if they think that Social Security is going to pay, Social Security is not something I would advise using in any sort of retirement calculations. Number one, because in the best case it'll be means tested, and in the worst case it may not even exist. Can you hear me now? Anyway, I don't think anybody heard anything there for that first second. Huh. Um, Types of life insurance companies and policies. Okay. Distinguish between two types of life insurance companies and analyze the various types of policies that companies issues. So this really isn't that important to you. Do you really care how the company is organized? Not so much. But stock life insurance companies, those are businesses where they have stockholders and all that. 75% of that type. And non-participating policies, since compared to the mutual type companies where the insurees are the owners. So that's a little different. Anyway, in terms of premium, if you want to pay the same premium each year, choose a non-participating with guaranteed premiums. Okay, you don't really have a stake in the company. The company's owned by investors, so it makes more sense to compare it to a mutual life company. This is the smaller portion, right? They're saying about 25%, but it's actually owned by the policyholders. So, says the premiums are higher, but you get a dividend. And again, that dividend is based upon the performance of the company. So what that means is, what kind of rate are people dying? If it's a bad year and the company's paying out a lot, that's going to be a little skosh on the dividend. But if people are living longer and they aren't having to pay, then that's a little better. So, term life insurance. So, protection for a specified time. If you stop paying premiums, coverage stops. Renewability, you can renew it without having to a physical at the end of the term, although your fees may go up. So, term life. Let's just talk about a little explanation on difference between term life and whole life. Let's say you're about 30, and these are ballpark figures. If you want to buy $100,000 worth of coverage, and you could buy this in any increments you want, but for every $100,000 of coverage you want as a good health 30-year-old, it's going to be about $7 a month. So it's reasonable and it's easy. I mean, I need 300,000, so I want to pay, $21 a month, and it's done, and life is good. Since it is fairly inexpensive, you would get that excess money and excess as opposed to what you'd be paying for some sort of whole life policy, and use that to invest. Now, if you're just going to, spend that on restaurants and everything else, then the benefits between the two are going to be decreased. But okay, so that was term life. We're talking $7 for $100,000 worth of coverage. If you want whole life, what's going to happen there is more complex policy, and this thing is an investment as well. It's going to have a value at the end of it. It's going to have that $125,000 plus interest on there, but the interest is going to be quite low, a couple 2-4%, something like that. So anyway, in order to get that $125,000 coverage, or $100,000 coverage, I'm sorry, on that type of policy, it's going to cost you about $100 per month. So now we're talking a sizable amount of money. If you need, $300,000 worth of coverage, you could be spending $300 a month on insurance. Now, granted, that insurance is going to end up as an investment, but the problem with that is it's that opportunity cost that's killing you. You're spending, well, let's just leave it with the $100,000 example, 7 versus $100. So you're spending $93 more a month, but you're getting some investment value at the end. But again, that investment interest is not good. And oh, by the way, an agent sold it to you. Term life, you can just go online and just purchase it quite simply. You can do that sometimes with whole life, but typically you use an agent. If you use an agent involved here, the first couple of years are going to be basically paying his commission. And so that money's not going to be part of your investment. So it doesn't work out good from an investment standpoint if, as compared to a term life, where you buy the $100,000 worth of insurance for $7, and you get that other 93, and you put it in some sort of mutual fund stock type thing. I mean, some of these traditional yields on these things are 7, 12, or 10, 12% on a lot of mutual funds. You are not going to get anywhere near that in a whole life type policy. So I don't know if I've confused you too much, but do a little research on your own. But I think you're going to come back to the term life type thing. And the term life, the deal with this is it's so easy to start a policy and cancel a policy. There's a particular point in my life where I just had my first daughter was born, and I was flying fighters, and I was going overseas to I guess this was Kosovo, one of these wars, and I'd already been flying in Iraq, and I'd seen a lot of things, and I needed protection, so I went out and I had about $700,000 worth of insurance, and hey, the war went well, everything, I got home, no problems, and quit that insurance after a year, and dropped back down to probably about a $400,000 or $450,000, which was more reasonable. But anyway, the ability to start it up and stop it was no problem at all. They did require a blood test, and sometimes they'll do things like that, because they're afraid bad things are going to happen to you. But I wanted I wanted my coverage to start immediately. A lot of times, without some sort of physical or at least a blood test, there may be a limited benefits program or period, they call it, where, if you die right after you get the policy, they're going to think you might have had some sort of pre-existing condition and they aren't going to pay you the full amount. So, sometimes, it was on their dime. They came out to my house and they did my blood test right there. It was kind of funny. But anyway, I had my insurance and I was able to go through that phase of my life without much stress. Multi-level term, yeah, that's typically what most people get. Can exchange a term policy for a whole life policy without having a physical. If they've already insured you under a term policy, they're pretty confident that just because you're taking a whole life doesn't mean that your physical condition is deteriorated much. Decreasing term, premium stays the same, but the amount of coverage decreases as you age. And the reason why they call it as mortgage insurance is if you look at your main debt, um, your mortgage should be getting close to being paid off by the time you get older. Now, term insurance, the $7 worth of coverage at 30, maybe 15 or 20 as you get, the next increment, say 20 or 40 years old, and then 50 years old, it's going to be maybe 60. And anyway, it's going to continue to go up the closer you get to a point where the actuaries say, yeah, this guy could keel over at some point. They're gonna raise that rate. So, I mean, it's fair. It's all up front. And the deal with these too is the competition is fairly transparent. I was just checking out a SelectQuote site, and again, I'm not a big proponent of, I'm not trying to push any one of these, especially SelectQuote, because I had bought some insurance from them, but I just went on there just to get a quick quote, for use in this class. And yeah, the first screen is, how old are you, and you know, uh, how much do you want? And so it sounds like, oh great, I'll just get a quote here. And then the next page, they want my name, my phone number, my everything. So I don't want to get sucked into a you know unending battle of email marketing. So I stopped there and went to another site and got a quote from them without having to provide personal information. So I advise you to do that. The other thing too is even if you went with one of these comparison type things, it's sort of like buying airline tickets where you go to Expedia or Hotwire and they do the pricing. Make sure it's with a major company, a company that you've heard of, or you can also check with some things called like AM Best and a couple other agencies that rate companies to figure out which ones are legitimate. Anyway, if one of these quote agencies on the internet says, oh, you can get this type of insurance with I want to say one of mine was with GM Capital and a few other folks. I mean, these companies I had heard of. Anyway, you get that information from that internet quote page, and then you go directly to that company, and you can probably get the same rate and cut out any sort of third-party involvement. So anyway, it's just like the airlines. If you see a good price on Expedia with Delta, many times you can go to the Delta site and get the same price and have a little bit better customer service. Although customer service in Delta, that's kind of a anomaly. Maybe, well, I'm not sure what a great airline is. I'm not going to get in that business. But anyway, you're probably better off though working directly with a company rather than a third party. Okay, so here's this whole life insurance, also called straight life. You pay a premium as long as you live. The amount of the premium depends on your age when you start the policy, and then it provides death benefits and accumulates a cash value. So you can borrow against it, but again, it's is it insurance or is it an investment? And they're saying, oh, it's both. Well, I just don't like that sort of complexity. I don't, when I need an agent or somebody else to sell it to me, and there's a history of, I wouldn't say fraud, but misrepresentation in this industry. I'd steer clear of it. With any insurance policy, don't be too afraid if you have some buyer's remorse. There's typically 10 days you have to rethink that situation and get out of that policy. But again, with the term life thing where you're paying, $7 per $100,000 worth of coverage, um, I think we can all live with that. Look carefully at the rate of return of your money because again, the investment bit is, you know, if it's barely keeping up with inflation or a little bit below inflation, that is not a good investment. Limited payment policies. So pay premiums for a stipulated period of time until you reach a specified age, and then you're kind of vested and you don't have to pay anymore. But again, the benefits are going to be proportional to the amount of money you have in there. Variable life, minimum death benefit guaranteed, but death benefit can be greater than minimum depending on earned dollars. Okay, so these are kind of a policy to make these whole life insurances seem a bit more palatable because they're invested in the market and they're doing a little bit better investment strategy because they know a lot of folks are not selecting that type of insurance because of the poor investment return. So variable life is a step in the right direction, but again, overly complex for my taste. Adjustable life. Okay, again, marketing type terms. Adjustable life. You can change as your needs change. Increase, decrease coverage. That's a nice feature, but again, it's still the same type basic product. Universal life. Can pay premiums in almost any amount, increase the cash value, increase the interest earned on short-term investments. So again, these long, I just do not like investments and insurance mixed together. Group life insurance. Okay, this is just term life insurance, so not a problem there. Often provided by an employer, no physical is required. So a lot of times there will be one of the benefits of working for a company will be a certain amount of insurance provided to you, and then if you want to go over above that, you can purchase more. So you will often find it's probably a pretty good deal because there's some subsidy, paid by your employer, subsidized. So you'll pretty common to have that type of insurance. Although benefits in general are, on the downside, but I know I have two term group insurance policies provided by employers, which is fine. Endowment, yeah, again, different situation. Coverage from the beginning of the contract to a maturity date and guarantees a payment of a specified sum to the insured. Not, I can't come up with any great reasons to encourage you to get that product. This credit life insurance, this is kind of a come on. A lot of times you'll see some fairly heavy marketing with this, and they'll point it out as a good deal to you, but really it's the the credit granting agency trying to make sure that they're covered in case you pass on. And a lot of times it is more expensive than traditional insurance. So you'll a lot of times see that when you get a new credit card, there'll be some sort of Scooby in there thrown in there to try and entice you to do that. They'll do this with mortgages too. It's another form of that where your mortgage is paid off. Um, that's not a bad concept. It's just usually the price is a little bit more than what it would typically be for just a cash type insurance policy. So, important provisions in life insurance contracts. Naming the beneficiary. Obviously, that's a personal decision. Um, and the contingency benefits, so or beneficiaries. The thing is if somebody is named as your beneficiary, they should have a copy of the policy because you're not going to be around to help them out with that, especially if it's kept in a safe or something like that too. You never know what might happen, but that's not one of those things you want to keep a secret. Um, the grace period for late payments, you don't want your insurance, canceled out from under you because you know missed the payment. Number one, you need to keep up on that, but you need to figure out that it's a reasonable grace period. Um, yeah, the accrued benefits. Again, we're talking term life type, or not term life, but whole life type policies where you're invested in it. Term life, if you don't pay after a certain grace period, it's just going to be canceled, and they won't pay off, and there is no cash value to the policy. Incontestability, yeah. Again, this was in response to fraud on the part of companies. Basically, they were saying after 2 years, they can't dispute the policy. They can't come up with some loophole why you shouldn't have been insured. They're kind of stuck. Suicide clause. This depends on how the policy is written, but basically, if you commit suicide, not only not doing your friends and family any favors, but yeah, they aren't going to get the insurance money, or not the whole amount. Typically, it'd just be they'd refund your payments to you. So, um, yeah, during the first 2 years, typically. Automatic premium loans. So, um, again, one that has a cash value, not a term life, but a whole life, they'll take it from their interest. Misstatement of age. You know, this whole thing is kind of funny. You say you're younger than you are. Well, they say the penalty for that is to pay a lesser amount. But anyway, it doesn't seem like there's that's much of a downside risk. I mean, the worst case, they're going to pay you as if you were older when you took the policy. So anyway, policy loan provision to borrow against cash value. Again, not the type of policy I'd recommend. Um, riders to contracts are just sort of amendments to contracts, and they'll exclude certain things, or actually, in the case of life insurance, they'll include things, such as if you're killed in an accident. They'll talk about that. Yeah, accidental death benefit. That would actually be a rider where you'd get double the amount of money. Waiver of premium and disability benefit. So if you're disabled, you can't pay anymore. Your insurance would still stay in force. And then the guaranteed insurability once you've started the policy. That's a part of the policy where they wouldn't cancel it on you after develop some sort of condition. So a couple years into it, you find you have diabetes or something else that theoretically may shorten your life. They can't just cancel it out from under you if you've got that clause. Cost of living protection, accelerated benefits. I mentioned this a little bit before. So your family's going to get whatever, a few hundred, $400,000 or whatever once you die. But if you're actually declared terminally ill, possibly they can get some of that money and use it even in your treatment. So, second to die option, also called survivorship. So, this one, before the policy would actually pay, both people have to die. So it's really more about the estate. The one that's still living is not going to get a windfall until they die, and obviously they aren't going to be in a position to spend it. So, pretty grim subject all in all, life insurance. Create a plan to buy the insurance. Okay, so public-private sources, companies rating AM Best. Those guys are pretty popular, although I don't know that I'd be paying a fee for services. But if there's a rating that's available within the insurance, but again, they're going to make these things sound very similar to the big boys or whatever. But you're familiar with insurance companies, New York Life and Allstate and those kind of people. I think their rates are going to be fairly competitive. And if you're buying direct, I'm just not a big fan of including an agent in the process because it's they're not working for free, and if you're buying the whole life, well, that commission is going to be used for your first 2 years. Essentially, all of your investment would go to them. And if it's term life, you're going to get a lesser product at a higher price. So Term life's pretty simple. You could do that direct. You can also go to regular old Standard and Poor's too, and that'll tell you the business health of a company. So, choosing your insurance agent. Um, yeah, sometimes people have traditional agents. I don't. I have a company I deal with, and that's what works for me. If you're more comfortable of having one person kind of handle all your policies, that's fine. But I'm more than happy with just a company, and I do most of it online. So, um, I obviously I'm not being sold, and they don't have other products they're trying to foist upon me, and the rest of that. So, it's up to you. Again, you know, when I buy a car, I don't want a salesman really. I mean, I pretty much know what I want, and I'm kind of the same thing with insurance. I can do the math. I can figure out what would be a reasonable amount to cover all my expenses and take care of people after I'm gone, and I buy that amount of term insurance, and then I move on and do something else. And that money that I saved by buying the term versus the whole life, I invest that, and that's really where you want to end up. I mean, you want to be self-insured. You want to have an estate. So let's say you put, going back to that original example, you're going to buy the $100 worth of term life, or the 100,000 dollars worth of coverage, and you're going to do it with term for $7 versus the whole life for 100. Well, if you got that extra $93, if you put that in mutual funds and just started doing that, um, I think in the example I had there was about $700,000 you were going to generate in terms of money by the time you likely pass. Well, that 700,000 is, that's self-insurance. That's going to cover your debts, and it's going to leave something in an estate. So you are self-insured at that point, and that's in my mind, a better way to be. Comparing policy costs. So yeah, how selective are they? Whom do they insure? Again, this gets back to the blood test thing. If you're doing one of these things where it's kind of one size fits all, we'll take anybody, and let's say you're under 30, well, maybe that's reasonable because you know people don't have huge medical issues typically at that age. But if you're getting in your 40s or something, and they don't want to do a physical, and they aren't concerned whether you're a smoker or not, um, it depends whether you are a high risk person or not. If you're somebody who's healthy, you probably want to get points for being in good health, and you want them to inquire about all those things. They don't you don't want to be lumped in and have um, you know whatever people with issues making the rates more expensive for you. So again, it's kind of a cruel, vicious world out there. But when you're looking at insurance, you're looking at being in a pool of folks that are going to be able to be insured for a low rate. So that's really what they're saying in all these: mortality rate among policyholders, how selective they are, and then the policy features and competition from other firms. Again, now, especially on the internet type comparison things, it's there's a lot of price pressure on these companies. So um, you are going to be able to get pretty good value as opposed to just a limited number of options from a salesman. Again, use interest adjusted index to compare policies. Takes some time. Okay, so this again has to do with whole life insurance policies. So if you're going to go that route, um, at least check out um, the rates, not only amongst the whole life policies, but also compared to the method I was talking about of conventional investments. So again, that opportunity cost of your money. Um, Obtaining a policy. This is very easy to do. Obviously, you're going to read the contract. After you buy it, you have 10 days to change your mind. And beneficiary is a lawyer. Yeah, most of us don't have a lawyer set up, but definitely, you hopefully have a will somewhere that other folks know about, and that insurance paperwork would be with it. But the medical history and all that. It's there's going to be some lengthy forms involved, but again, you want to be in a fairly selective pool of low risk individuals to get the best rate on insurance. So some of that may be a hassle, but that hassle may actually be to your benefit. Settlement options. Okay, so this is really for the survivor. Yeah, how are they going to get paid? A lump sum, limited installments, or life income. Also, well, the company, and they could pay interest to the beneficiary. But again, the system you choose, the option you choose, should match your debts. So if it's going to be a regular incurring type thing like a mortgage, then maybe some sort of installment or life income options. Again, I'd hope for your survivors have more sense, but if you look at the studies of like lottery winners, they're given a lump sum and they usually end up broke within a couple of years. So um, some sort of income method might be the best. Switching policies. um, yeah, this is going to be more difficult, especially if it's in the whole life type thing, because they're set up as a long-term structured investment with high setup costs from the agent who sold it to you. So, and then, the older you are, the higher it's going to get. And you can get to a point if it's not renewable, if you let it lapse, and then they do a physical and they do discover something, you could end up uninsurable. So you want to stay on that and hopefully not have a lapse. Even if you have term life, make sure there's some sort of provision for renewing and keep it renewed. Annuities. Okay, so that's a financial contract between an insurance company that provides you with a regular income. So this is the other side of it. Um, they're you're betting that you're going to live a long time, and they're going to pay you a certain amount of money, and if you die early, well, then they win. If you live a long time, then you win. So people buy annuities to supplement retirement incomes and shelter from taxes. So there were some laws passed 2010 and also one back in 2007. Anyway, that related to the tax benefits. Now this one is Healthcare and Reconciliation Act of 2010, 3.8% income tax on high-end individuals starting. So anyway, that's not a good thing. That's a increased tax on those interest, dividends, and capital gains. So the annuity would fall in that category. Those who expect to live longer than average benefit most from annuities. So just what I said, just the opposite of life insurance. And it's going to continue to pay. And a lot of retirement plans are structured like that, where they're annuities. So can be a good thing. And the only variable here is what's the rate of return. So you'd have to check on that. All right. So in a nutshell, just 30 slides. But that's the basic guidelines for the insurance. Any questions from the few folks who are out there? I think the problem with the microphone at first, I think it'll replay on the YouTube. So if anybody didn't hear the first couple minutes, did Susan Rodriguez have a question? Got her hand up. Any questions? If someone dies, is the spouse/family responsible for the debt? Well, it depends how the house is structured, but yeah, you could lose the house, especially if it's not paid off. Um, you would not, and that's one of the main um, issues is you've got a sole breadwinner, whether it's the man or the wife, and the stay-at-home parent is left behind with a huge mortgage, and if you can't pay, yeah, they are going to be responsible for that debt. Personal debts, no. If but if again, if you're in a married situation and you owe 30,000 bucks on your credit cards, for example, yeah, that's going to all fall to the survivor. So, if someone dies, is the spouse, family responsible for the debt? Yes, and also even the burial. And we're talking, depending on how elaborate you want to do it, 8, 10,000 bucks. So, yeah, insurance is something you want to definitely have. And but if you're just, say you're in a rental type situation and you just have, no children and all that, $7 a month for some term life to get you $100,000 worth of coverage, that could smooth things out greatly. But yeah, uh, kind of a Spanish example. In Spain, they had 60-year mortgages where the mortgage was basically inherited by the children. So these children are born into a family, and again, if they want to stay with that house, they're going to be responsible for that debt. Now, a lot of times you will see, mortgage type life insurance or other insurance that will cover that debt, and the lender will often push that to uh, obviously cover their loan, and it does provide you a benefit. Any questions? Did I answer your question? Okay. Yeah, you know, again, I know this stuff is can get pretty complex, but unless you're a big proponent, unless you've got, friends in the insurance business who've told you you want to get some sort of whole life policy, just keep it simple. Just look at what your debts are. Look at if you died tomorrow. Um, how much would it take to, get the family through the crisis, and, potentially, pay off the home and set up the kids with some sort of college type thing. And if it's paid off in a lump sum, you don't need to pay off the whatever. If you're given say you went with $200,000 worth of coverage, 100,000 to take care of debts, take care of mortgage for a significant amount of time, and 100,000 to put in investments. Those kids could go to school anywhere they wanted. So it doesn't need to be that difficult, that costly, and any of these insurance schemes that seem too complex and they need to be explained by an agent, I steer clear of them, and I haven't seen any advice from anybody but an insurance agent who you know pushes those things. So, all right, that'll do it for this evening then.